Thank you and welcome back to our amazing webinar series with our partner Polaris, brought to you by CareStack, Darby, and Polaris.
Wonderful. Thank you all so much for hosting this and helping us share a little bit of information this evening. My name is Perrin Desports. I'm one of the co-founders of Polaris, and welcome to everybody who is on the webinar this evening and who has also been with us for the first three installments of it. We're going to focus on Novos tonight. Once again, thanks to our hosts at CareStack and Darby for making this happen. We really enjoy the partnership, and it's been wonderful to be able to share some information with everybody in the audience. Here are the disclosures of relevant financial relationships. I'm an owner of Polaris, and I don't get paid for any of this. That's pretty much the long and the short of it. As I mentioned, I am one of the co-founders of Polaris, and my background specifically is in dental distribution. I actually ran 3 different businesses for Patterson Dental Supply over a 15-year career and left them to become an entrepreneur about 6.5 years ago. All of my work since that point in time has been in the group practice space. Polaris is a firm that guides entrepreneurial dentists, like many of you in the audience, to both build and exit successful group practices. Group practices are our only focus. We really don't work with private equity-backed groups, and we really don't work with solo practices unless it's an individual who wants to build a group. That being said, the subject matter for tonight's webinar is de novos, cold starts, cold dark shell, and how we use that as part of an overall growth strategy. For those who have been on the webinar series up to this point, like I mentioned, this is the 4th in a 7-part series. What you're going to see in front of you has a lot of math to it and a lot of granular detail. If you'd like to download a PDF copy of this webinar, you can do so at the QR code there on the lower right-hand side. So I'll let you put your tablet or phone or what have you up to it, access that, and then start the download. For those that might miss it, there'll be an opportunity to download it at the end to give you just a second to do that. And for those who have not seen the first 3 installments of the series, I think my contact information's at the end of the deck. You can send us an email and we can send you some web links to view any of those if you like what you see. All right, so this is a little bit of a refresher for those who have been on the series up to this point, but you've heard me say that dentistry as a profession is at an inflection point. And I get asked the question a lot. I speak at a number of conferences and take probably 5 to 10 prospective client calls a week. And I'm always asked, Perrin, am I too late to start a group practice? Has all the consolidation happened? And has the boat already left the dock, so to speak? And my answer to that is absolutely not. I think we have a good 10 to 15 year run ahead of us where there's ample opportunity to create a lot of value in group practices. And if you look at the little aspect in the red bubble at the bottom, this is a market that is seeing a proliferation of emerging and group practices that are all less than 10 locations. That is the fastest growing segment in the space of dentistry. So I do think that there's still ample opportunity to create a lot of value, whether you want to build a business for cash flow or build a business for exit. By the way, one thing we didn't state, or I failed to state at the opening, is if you would submit questions through that Q&A button on your dashboard thing, and we'll group them all and take them at the end versus trying to do it along the way. So I love including a little bit of fortune cookie wisdom, as I like to say in my presentations. And this is a great one. That's a Chinese proverb. It says the best time to plant a tree was 20 years ago. The second best time is right now. And I think that's kind of the mindset you have to have if you are going to build a group practice. There are probably a lot of you in the audience who have read a book called Good to Great by Jim Collins. It's one of a series of books that he wrote, and they're all really good, well-researched, obviously. And he's got a lot of quotes, but one of the ones I like the most is, whether you prevail or fail depends more on what you do to yourself than what the world does to you. And that's really a quote that's emblematic of focusing on the opportunity at hand and blocking out the noise. And if you're going to build a group, that is of paramount importance. So there are 3 key fundamentals to address in this early stage journey, and I'm going to knock these down for you very quickly. And then we're going to get into the aspects of how they relate to a de novo strategy. The first key is simply avoiding failure, and that comes from understanding the fundamentals around financials. We work with a lot of people who are building group practices, and inevitably, too large of a number of them come to us and say, I own 4 practices right now. How is it that I'm making less income than when I only owned 1 practice? How is that possible? And it's not just possible, it's an alarmingly frequent scenario. And there are a couple of things to think about as it relates to this, and there are 3 aspects to solve for here. One is replacing yourself clinically. If you're going to build a group practice, somebody's got to lead that business development and that growth. And if you're the founder of the business, it's probably going to be you. And that's going to be incredibly challenging if you're still practicing clinically a full load, 3 to 4 days a week. The second piece is a fundamental understanding of EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a proxy for operating cash flow. That's pre-tax owner income, if you will. In our world, we normalize it for doctor compensation. If you're the founder and owner of the business and you are working clinically, you have to normalize your replacement costs for doctor comp. EBITDA is also the basis for both valuation and lending in the group practice space. And those are 2 of the most, arguably most important aspects of understanding that metric. And the last piece is understanding free cash flow. That's cash in our bank. That's what we pay our bills with on the home front. And if you don't understand how all of this relates to one another after debt service and after taxes are paid, this is where you start to get into a little bit of a hole. So let's take a look at an example. And this is why I suggested to download the deck, because there's going to be a lot of math coming at you quickly here. So this is a $1 million revenue practice, general dentistry practice, that's split 80-20 clinical to hygiene, and it's running a 60% overhead rate. When we take the $1 million in revenue and we subtract the overhead of $600,000, our owner has pre-tax operational income of about $400,000. If he or she pays Uncle Sam some blended tax rate, I'm just using 25% to illustrate here, pay the government $100,000 and you're left, and let's say you have no debt on this business, you're left with about $300,000 worth of free cash flow for you and your family. From an EBITDA perspective, that same business, $1 million in revenue, split 80-20, clinical to hygiene, running a 60% overhead rate. From an EBITDA perspective, we normalize our owner compensation as attributed to the clinical collections that he or she derives. And in this world, since it's a general dentistry practice, we're going to use a 30% clinical compensation rate. So the amount of income that the owner derives from clinical services rendered is about $240,000. When we take $1 million in revenue and we subtract 60% overhead and subtract the attributed doctor compensation, we're left with entrepreneurial profit of about $160,000. And entrepreneurial profit is a close enough approximation of EBITDA for this example. Again, pay the government some amount in taxes and you're left with $300,000 in free cash flow, just as I mentioned before. So let's go out and acquire a practice. And this practice is set up the exact same as the one we own. It's a $1 million revenue practice. If it were listed by a broker, it might list for about 80% of revenue, or $800,000 is the amount it might sell for. It's split 80-20 clinical to hygiene. It's also running a 60% overhead rate, and attributed doctor compensation at a 30% rate is $240,000. If we bought this business for $800,000, that $800,000 valuation is a 5 times EBITDA multiple. Put another way, if we take our entrepreneurial profit of $160,000 and we divided it into the valuation of $800,000, the result is a 5 times multiple. That's the way you reconcile valuation as a percentage of collections or percentage of revenue if listed by a broker versus the way you calculate it as a multiple of EBITDA. And that's a fundamental that you really need to understand if you're going to build a group practice. So in this situation, we've gone out and bought this business. We're paying an associate to work in the business. It leaves about $160,000 worth of EBITDA. We pay some amount in taxes, again, using 25% rate here, or $40,000. And we've borrowed money from the bank to buy this business. And it's a 10-year term at a 4% rate. I built this deck a number of months ago before rates went kind of crazy. So they're probably a little bit higher than that. But the annualized debt service to buy this business, about $97,000. When we take our entrepreneurial profit and we pay off our taxes and we pay off our loan that year, we're left with about $23,000 worth of free cash flow to us and our families. So what happens? When do we start losing ground here? Well, let's just say that that was a fairly successful acquisition, and we don't want to stop at 2 locations. We would like to acquire more locations. And as I mentioned before, if I'm going to build a group practice, it's going to be really challenging to do that if I'm working a full-time clinical load. So in order to free myself up for business development and find more practices to acquire, I'm going to bring on an associate and basically take over 2 of the 4 days a week I'm working clinically. We're going to split the overall clinical collections between me and an associate. Again, paying that associate 30% of his or her collections, and you can see that the compensation that's attributed to that. But now I'm paying somebody to do the work that I no longer want to do. And it lowers my pre-tax income because I'm paying an associate that wage. It also lowers my taxes, and the result is a decrease in free cash flow. Well, why do I want to do that? Well, the idea that behind it is because it will allow me to acquire more practices, and I can make back that income through multiple businesses being owned. So let's go out and acquire another practice, a 3rd location that's similar to the one that we bought before. It's also $1 million in revenue. But this one, when listed by a broker, values at 90% of revenue. Maybe it's a more competitive process. Maybe it's in a better area of town. I don't know. Maybe it has different payer mix, but we have to pay up to get it. We're going to pay 90% of value of revenue, or $900,000. Still split 80-20 clinical to hygiene, but this business is also running a slightly higher overhead rate. Maybe the staff has been there longer. Maybe it's just a higher cost of supplies or rent or something like that. But the overhead rate for this business is 65%. So we're paying more in terms of valuation, and it's a costlier business to run. And when we do our analysis, we see that the entrepreneurial profit dropping out of this business is down considerably from the prior example, and the EBITDA multiple that we paid is a lot higher. It stands to reason that we're going to pay less in taxes because it's creating less operational cash flow, but we're going to pay more in debt service now because we're paying a higher valuation for it. And this is the first scenario where when we take our entrepreneurial profit or approximation of EBITDA, we pay Uncle Sam their fair share, and we pay the bank what we're obligated to, we start to go in the red. And this is a scenario that we see very often where a successful practice, successful being profitability, is actually funding a practice that is cash flow negative. So what do? We want to go out and buy a 4th location, obviously, right? Let's buy the ADA average practice, about $750,000 in revenue. This one values at a lower multiple of revenue, 60%. It's a smaller business. It's half the dollars that the prior one cost us to buy. We can't turn it down, right? Well, it's slightly higher overhead rate as well, because this is a business that struggles maybe to clear some of its fixed costs. And you can see where the entrepreneurial profit lands in a business like this after we normalize for doctor compensation. You can also see the EBITDA multiple resulting from that. And even though we paid less in dollars, it's a much larger EBITDA multiple. There's less attributed to taxes because we're not making as much in terms of operating income. And there's lower overall debt service, but this is a business that goes further in the red because it's not generating enough operational cash flow to begin with. So what happened? We started out with a great practice and a great life. We were making pretty good income out of that business. We had no debt on it. It was pretty predictable. We went out and acquired 3 locations. So now we're generating about 4 times the revenue on the top line, but on the bottom line, we're generating about 30% less in income. and this is a scenario that we see all too often, it's completely avoidable, but at the same time, it catches many people unawares and it creates massive problems on the home front in terms of a decrease in free cash flow. The second key to building a group practice is really deciding what you want to build, why you're trying to build it, and how fast you want to do so. This is a question that we ask in a lot of our decks, and I think it really gets to the point. And I would encourage all of you to maybe contemplate this, not tonight on the webinar, but this weekend or sometime when you might have a cup of coffee or a little bit of idle time. And if you're contemplating building a group practice, really ask yourself, if we're having this conversation 3 to 5 years from now, what does success look like for you both personally and professionally? Both personally and professionally. The reason that's so important is because these businesses are dynamic and they put a lot of stress on the home front, and it's really hard to separate your personal life from your professional life. But if you're not clear about where you want to be 3 to 5 years from now, the likelihood is that you're going to build a mess. So what are you trying to build and why are you trying to build it? And that kind of sounds obvious, but I'm going to give you some more specificity here. Growth in size, like how fast do you want to build this thing? How many locations do you want to have? And how big is each location? There's a significant difference in building a 10 location group that's 6 ops per location versus 6 locations of 10 ops. Those are completely different businesses, yet they have the same amount of operatories and probably roughly the same amount of revenue. Are you going to build it so big that you want to centralize administrative infrastructure and create a platform? Or is it just a daisy chain of businesses for cash flow and lifestyle? Is it going to be uniquely branded, which might help with your marketing efforts? Or is it going to be branded by location? How much debt and chaos are you really willing to take on as the primary owner in the business? What's your realistic stress level? That being said, you want to have multiple partners in the business. I have a partner in Polaris. We're 50-50 partners. DeWalker Sinha is my partner. But it may be that y'all want to be primary owners of the business and have minority partners or anchor dentists in each location. Is this a business that's built for sale or built for operation and cash flow? Those can be really different businesses, and it's important to kind of understand the context around what that ultimate outcome may be. So if you want to undertake a strategy of build and operate versus grow and exit, they can look very different. Build and operate is building a lifestyle business. It's usually cash flow or income that you're oriented toward, and it's maybe 3 to 5 locations, very manageable, probably focused on personal income, if not the sole owner, certainly the majority owner, manageable stress and a relatively low debt level. With limited expansion and no centralization necessary. On the other hand, if this is a build for exit type of a scenario, it's really going to place a burden to reinvest a lot of that distributable income back into the business for growth and scale. You're probably focused on wealth from a transaction, and it's realistic to assume that you're going to have multiple partners at possibly different equity levels. This is surely going to be a business that's a lot more locations, a lot more debt, and a lot more dynamic organization. Michael Porter is a Harvard Business School and Wharton Business School professor, and he's written a lot of seminal texts around competitive advantage and competitive strategy. And a great quote from him is Strategy 101 is about choices. You can't be everything to everybody. And the essence of strategy is simply choosing what not to do. Don't be everything to everybody. Focus on what you're good at, what you can execute on, and you stand a better chance of building a greater business. Key number 3 is defining your time frame and your outcome. And when we say that, I mean that's number of years and numbers per year, meaning number of years on the horizon and the number of location count growth per year. You want to reverse engineer what those expectations are. And when I say reverse engineer, if it's 5 years out, you want to understand, is this, what's the outcome here? We want to generate wealth from a transaction, or is it income from cash flow? What is the dollar amount of either one of those? How long do we think it's going to take to get there? And then finally, in order to get there from where we are right now, what does that mean in terms of growth each and every year until you can hit that finish line? It's amazing how many people want to build a business that they have some specificity in their mind, but they have no idea how to connect the dots from today to that ultimate outcome and understand the context around the growth, the stress, and everything else that comes along with it. So if you sit there and say to yourself, I want to build a business that generates income of about 1 million to 1.5 million in 5 years, versus I want to build a business that I can sell for a net walkaway of $10 million in 5 years, those can be very different businesses. And getting clear on what matters most is really important. So this is an example that's a little bit whitewashed and taken from a financial model that we built for a client. And what we do is think about those outcomes that the client wants in terms of the activities they're going to have to generate each year to get there. And we model out where the business sits presently, along with the anticipated activity level, either growth and acquisitions or de novos or a blend of both, to see what the revenue, adjusted EBITDA, and overall debt service is of a business like that. And we model it out over however many years it takes to yield that outcome. And then in this case, at the end of 5 years, we're able to see that this is a business through multiple acquisitions and a couple of de novos. This is a business now generating about 15 million in revenue, adjusted EBITDA of about 2.7 to 2.8 million, debt service of about 1 million. And if you take your EBITDA less your debt service, you can kind of see that you might stand a pretty healthy chance of hitting that 1.5 million in passive income or cash flow out of the business over that period of time. So this is getting really specific. You don't have to build a financial model as sophisticated as ours. I wouldn't expect you to, but you got to do something more than simply just hope and pray about it. All right. So reverse engineering what the outcome is that you want and where you stand today, then connecting the dots in terms of what it's going to take to get there is absolutely mission critical. The same can be said on a wealth changing transaction. If we model out that same scenario over a 5-year period, and we're looking at different EBITDA levels, now we want to see what the valuation multiple might be for a $2.7 million EBITDA business. And in this world, maybe it's somewhere around 8 times. That it could be less, could be more. This is just an illustration, but we subtract the overall debt burden from the business of about $5 million. We allocate some amount to taxes, and we see the net walkaway number is in excess of that $10 million threshold that we specified in the outset. So this is getting specific about what that journey looks like. And we say, be crystal clear about how you define success 3 to 5 years out. This is what we're talking about. So, solving for success. The prior webinar in this series was about acquisitions. Again, if you missed that, send us an email and we can try to get you a link for a recording to it. Tonight is more about de novos, building. And when we contrast those two aspects of growth strategy, there are positives and negatives to both, understandably. Positives for acquisitions are it's arguably easier to find practices to buy, and those businesses have some amount of patient staff and hopefully some amount of positive EBITDA. Maybe there are potential synergies and revenue upsides and cost containments with your existing business. The negatives, though, are that you're probably going to pay more for an acquisition. And if none of you have lived through this, I'll tell you, culture issues and change management will erode value and undermine your integration strategy faster than anything else. Overall, acquisitions are seen as having less downside risk. I don't know that that's necessarily the case from our experience, but that's what a lot of people view it as. De novos have a lot of positives. You can do it your way, the right way, the first time, meaning it's a blank canvas. All of your common brand and marketing synergies apply. It's easier to create those repeatable processes and consistent outcomes when you truly get it dialed in. And arguably, you have lower upfront investment costs on a de novo. The negatives to it is that obviously there's potentially a slower growth ramp overall. That's growth ramp in terms of revenue generation from new patient attraction. And de novos are heavily dependent upon the initial investment, the build out time frame, and the ability to execute that marketing campaign. Overall, a lot of people have greater fear of generating new patients, and they're unsure how to define success in a de novo, and that's probably why fewer people adopt this strategy. That being said, DeWalker and I at Polaris love the de novo strategy, and we've seen a number of clients execute this to a great degree of success, and even so much so as to do it at an enterprise level. When DeWalker, my partner, was a VP of sales for a bank called East West Bank, they loaned a lot of money in the group practice space, and their largest client was Pacific Dental Services. And at the beginning, Pacific Dental was a de novo type of a DSO. And he learned very quickly from Steve Thorne in that group how they executed at scale, and how successful a de novo strategy can absolutely be. So when we start talking about de novos, it really comes down to variables and variance. The first is obviously finding the right site. It's a real estate play, right? I mean, you want to make sure that you find the right location that reflects the patient persona that you're trying to attract. You want it to be on budget. All too often, de novos become a choose your own adventure. I mean, you have a budget that has cost overruns and over order on equipment, and you get more ornate than you need to be, and all that kind of stuff, and the budget gets blown out of the water. And that's the first cornerstone of a problem. The second is that it needs to be on time, minimize delays from construction, credentialing, hiring, all that kind of stuff, and make sure that that opening date that you set out is really the one that is going to reflect all the operating budget inputs that you put in there. And then driving results, having a 12 to 24 month pro forma, a plan to show growth metrics and the ability to deliver on those that yield operational results and financial results, and be able to do that with confidence. And if you can replicate this strategy very, very easily, because your bank is going to love you. Banks don't love de novos because all too often the people who choose this type of strategy are just going on a wing and a prayer, and the bank's got to wait until you really are able to create success in terms of positive cash flow after debt service and creating some level of equity on balance sheet. I would tell you that if you know the variables to solve for, and you have a solid pro forma and proof of concept, your bank's going to love you because it takes a lot of the variables out of this. And I'm going to show you that right now. So here is a very simplistic way of starting this thought process. As I mentioned before, the keys to de novos are really being consistent with your build time frames and your investment costs, being on budget and on time, being able to forecast your EBITDA margins, as well as your accurate new patient values and new patient counts, and then driving your revenue to the outcome goal that is the most important thing. And I'm going to show you what that thing is right now. So as just an example, we are trying to create equity on balance sheet. If our initial investment is $600,000, build out equipment, etc., and if we know our bank maxes out in terms of debt to EBITDA leverage at 4 times debt to EBITDA, for a $600,000 build out, we know we have to hit an EBITDA target of $150,000 by the end of year 1 if we want to continue this strategy year over year. If our forecasted EBITDA margins are 10%, to hit $150,000 in EBITDA at a 10% margin, that means we need to generate revenue of about $1.5 million at the end of the first year. If a new patient in our practice has an average value of about $1,000 per patient, that might be a comprehensive exam, a cleaning, an extraction, and a crown or something like that. But of all the new patients we had last year, we total up the treatment that was delivered to all of those new patients, and we divide through by the number of new patients, we come up with an average first year value. And so if our if that number in our world is $1,000 per new patient, that means we need 1,500 of them to yield $1.5 million. And if we know the cost to acquire a patient is $100 from our marketing company, that means we need to spend $150,000 on marketing to generate all of that outcome. Now, at face value, if I told you had to spend 150 grand on marketing, you'd think I was crazy, maybe justifiably so. But if I said you need to spend $150,000 in marketing to hit all of those metrics and yield an outcome that your bank is happy with at the end of 12 months, so they'll give you another 600 grand next year to do this trick all over again, you'd probably gladly spend 150 grand to do it. So this is the way we solve for bank funding in a de novo. And it's really one of the most critical components of a de novo strategy. It doesn't matter what your growth strategy is if the bank cuts off your funding. So if you're going to do multiple de novos or do them on an annual basis, you've got to maintain that growth funding. And the way you do that is solving for the variables that your bank values most and understanding the way they look at leverage, and then being able to course correct accordingly. So let's take a look at a little financial model as an illustration here. As I said before, hope is not a strategy. Know what you're solving for in a de novo and work the process accordingly. So when somebody says, hey, Perrin, I want to build a new practice and I'm just hoping that I can break even. I ask them, all right, well, let's define break even. Do you mean just you want to cover your operating costs, like put $1 of operational profit to the bottom line? Or is break even in terms of, or is it more in terms of positive net income, after debt service and after taxes? Is break even some aspect of a revenue number, an EBITDA number? Is it positive free cash flow? Is it equity on balance sheet? And how long do you want to take to do that? Is it a year, 2 years, 30 months? What are we looking at here? So if your goal is simply to break even and you haven't defined what break even means and in the time frame specified, then you're probably just going on hope. So let's build a model and show what we're talking about more than the one we just illustrated before. I would tell you that every model is wrong, but you got to start somewhere, and that somewhere is obviously working with your expected investment. So in this case, again, taken from a model from a client to illustrate the point here, this is going to be an 8 operatory facility. And in this area of the country, average construction costs about $125 per square foot. This is taken before COVID and all the inflationary context of the last year or two. We need about 300 feet per operatory. We're going to commit about 20 grand worth of equipment per operatory. We're going to outfit only about 60% of the operatories, or about 5 out of those 8 to start. We're not going to equip all 8 of them. Going to buy a digital pan, put some computers in there. We need supplies per operatory and some hand pieces and small equipment, a little bit of working capital. Total de novo budget of about $650,000, as you see at the bottom. So now we need to determine those key variables for outputs, excuse me. If the investment is $658,000 and if the max leverage for our lender is about 4 times debt to EBITDA, now we know that we need to generate about 165 grand worth of EBITDA at the end of 12 months. And again, if we're forecasting 10% EBITDA, that means about $1.6 million in terms of revenue. If the average new patient value for this client's $800, that means we need about 2,000 patients seen in the first year. And if it costs them $150 per patient to acquire a patient, that's a pretty big marketing campaign. But at least we're working a process to understand the numbers behind it. So we build a pro forma out of this. And you don't have to be a financial analyst to build this. A pro forma can be as basic as you need it to be, but it really needs about 5 different components. It needs to have revenue. That's a mix of doctor and hygiene for a general practice. It's got some level of fixed expenses, some level of variable expenses, and it's going to need to have some level of projected EBITDA, and it's going to have to show some amount of free cash flow after debt service. Those are the big buckets to solve for. You can use industry benchmarks for fixed and variable expenses, or you might take them out of your existing business. Then we want to pressure test that pro forma. So when we start running this out over a number of months, in this case 12 months, we can see some of the from the marketing campaign and the way we generate new patient flows through the business. We can see that at the end of that 12 months, the revenue line of the business is about $1.2 to $1.3 million. We forecast our fixed expenses and our variable expenses, and then we're able to ascertain some level of projected EBITDA. And you can see in the lower right-hand corner, it's about $73,000, $74,000. This is a business that generates operational break-even around month number 4, and it generates free cash flow break-even around month number 9. Excuse me, there we go. Operational break-even around month 4, and free cash flow break-even around month number 9, meaning we're generating enough profitability to cover the debt service for that month. However, at the end of 12 months, it does not generate free cash flow break even after debt service for those contiguous 12 months. That's important to be able to forecast, because we know right away that our bank isn't going to look real favorably upon this when it comes to loaning us more money. So how does it play out? Well, we had our targets. We built a pro forma, we ran projections, and what did we come out with? We came out with about a 6% EBITDA margin business, about 74 grand in projected EBITDA, and that's about a 9 times debt to EBITDA leverage ratio. Not going to be in the bank's willingness to loan us more money until we can pay down some of that principal and generate more volume of EBITDA to delever slightly. You can imagine that the bank's not going to be thrilled about that. So what do? Well, we haven't even really broken ground. That's the first thing. The reason that we build a pro forma is to be able to project all of this before we make spending commitments. And that's really key to de novos. You're never going to get all this right in your first model, and that's why you do it. You can make fine-tuning adjustments along the way and hopefully course correct to give you some more confidence about the outcomes that you're going to generate. Whatever you do, don't try to solve a shortcoming in the pro forma by saying something like, well, I'll just add about 30% more revenue to the business. That'll fix it. That's what we call sales covering sins, and that never works. So let's go back and make some minor course corrections. On the left is what we initially projected and the numbers that we ran out. Maybe we can scale back some of the equipment needs in each of those operatories. Maybe we need slightly less in terms of supplies and hand pieces, and slightly less in terms of working capital. So we're starting to bring down our investment cost and bring it down pretty substantially, as you can see on the right-hand side. We can also take a closer look at the targets we need to generate in terms of new patient values and cost to acquire a patient. This may be a little bit more fine-tuning of the numbers to generate those revenues and projections. And these are incremental changes, not massive changes. We can also look at some of the fixed expenses that we were originally projecting in the business, and it may be something like, we budgeted for meals and entertainment, but we probably don't need to do as much of that at a de novo. Probably going to be less repairs and maintenance required. Everything's pretty much new. And maybe we can scale back some of our travel that's required for CE or something along those lines. So as we start to evaluate the outcomes of these incremental changes, we're tweaking the revenue line, we're bringing down the investment budget, we're taking some of the fixed and variable expenses out of the business. This is now a business that generates slightly higher revenue, but it generates a lot more EBITDA. It also yields a positive free cash flow after debt service at the end of 12 months. And this is an outcome that our bank would be much, much happier with if we were able to hit it. And because we projected it out over a series of 12 months, we can course correct on a month-to-month basis as to whether or not we're hitting the numbers we need to yield the outcomes we project. And this is really the formulaic piece of a de novo strategy that is so important to get straight before you make $1 of the investment. So it's all about variables and accountability. Have that rough budget for what your build out and equipment costs are going to be. Have a marketing plan with a budget and a new patient number. If your marketing company says, hey, we'll just spend a bunch of money on social media and we'll get you a new website, that's not nearly good enough in this type of a world. If you're going to build a group practice, you've got to be able to drive revenue, and revenue is derived from new patient numbers. Have those monthly new patient and production targets. Make sure the marketing company and the operations team is familiar with both. Have reappointment rates and expense benchmarks. And again, make sure your operations team is dialed into that because they've got to be able to adjust them on a monthly basis. Now we know what success looks like, and we can tell if we're on the path to get there. And that's really the key thing to being formulaic in a de novo strategy. So here's some key takeaways for you as we're wrapping up this session. One, I would tell you that if you are, a couple of years from retirement, I don't know that taking on a lot of debt to do a de novo strategy or even build a group is in your best interest. We see a lot of, I'll just say, underperforming groups. So we don't believe that building a group is the right thing for everybody. And like I say, if you're, roughly 5 years from retirement, I don't think it necessarily is. But if you're 10 years or more, I think you owe it to yourself to consider building a group practice, if for no other reason than it may be somewhat of a defensible strategy. If you've got 10 years or more to go before retirement, dentistry is going to change a lot over that period of time. And if you're operating a successful solo practice, I think there are going to be a lot of pressures brought to bear, declining insurance reimbursements, the changing attitudes of millennials and younger patient demographics in terms of transparency and convenience, rising costs of doing business, et cetera, et cetera. And I think if you're relying on the amount of income that you're deriving today and thinking that you're going to be able to maintain that, indefinitely in a successful solo practice, I don't know that that's accurate, honestly. So consider building a group practice, but do it with all the right intentions in mind. Like I said before, it's not too late to start building a group if that's the right thing for you. But if you are going to do it, understand your financial metrics and get clear on what you're going to build, why you want to do it, and how fast with those defined outcomes. And obviously be a student, seek knowledge and experience, which is the reason you're on this webinar tonight, because trial and error costs money and it wastes a lot of time. Look, we're a consulting company. We help entrepreneurs build successful group practices every day of the week. That is what our business is. And those that we work most closely with and work best with are those that understand the value of time. I mean, I'm not telling you how to land a man on the moon tonight or cure cancer, all right? You can use the trial and error method to build a successful group practice eventually. The question becomes over how long and at what cost. And that's really the value that we bring to the table. So the first step to getting somewhere is simply to decide that you're not going to stay where you are. And maybe that building a group is the right thing for you. For those that joined us tonight and are looking for CE, the verification code for this webinar is Perrin 2023. I never thought I'd see my name in lights for CE redemption, but there you have it. Capital PERRIN 2023, all one word, is the CE verification code. For those that enjoyed tonight's webinar and you like this kind of business subject matter, I call it wonky subject matter, you might enjoy our podcast. You can find it on all the major outlets: Apple, TuneIn, Google, Spotify, Stitcher. It's called Group Practice Accelerator. We drop an episode a week and it's all this type of information. So I encourage you to subscribe to it. We also drop a newsletter every week that has links to the podcast. It's got usually a blog post, a video, and a lot of other pertinent information. You might want to sign up for stuff like that. And if you're curious about building a group, there are a lot of different services we offer, but a discovery day is a one-on-one session with clients in our Charlotte office. It's one-on-one because we do a deep dive into all the fundamentals of group practices. And because it's one-on-one, you can ask any question that's top of mind. We get a lot of nice compliments on those discovery days. People find a lot of value in them. And honestly, probably about 20% of the people who join us for those discovery days elect not to build a group practice. So it's not just a 6 to 7 hour day to talk about how great we are. It really is all about you and about the business you endeavor to build. If you're looking for more of a larger footprint event to attend in October, our friends at Darby and CareStack are going to be with us, along with the people from the Dental Success Institute. That's Dr. Mark Costas and crew, for our second annual Scaling from Clinician to CEO Summit. That's October 11th through 13th. The QR code is there. We'd love to have you join us. The feedback we got from last year's conference was really unbelievably high. You can see the agenda on the right-hand side, and that might be the right next step for you. For those who have joined us in the prior sessions of this webinar series, the next one coming up is going to be all about attracting and retaining associates. I can't remember the date on that one, unfortunately, but stay tuned. We'll get it out to you, and hopefully you can join us for that too. So I'll take a pause here for if we've gotten any questions, and try to provide some answers in the limited time remaining. And there's the QR code to download a copy of the presentation if you missed it early on, or to book a call with me directly. You can do that off the QR code on the right. So Kelsey, that's the end of this one. Do we get any questions or anything out there we need to dive into?
Thank you. Yeah, not yet. So I'm just going to leave it open for a minute. Just to clarify, I did put the link to the next webinar in the series in the chat. It's going to be on July 19th at 7 p.m. Eastern Standard Time. So if you'd like to join us, you can access it there, or also on your CE Zoom account. And also I put the verification code for CE in the chat as well, but I haven't received any questions. So if you'd like to wrap up a little bit early, we can, or we can hang out for a minute. What do you think?
Sure, we can wrap it up if no further questions. Hopefully everybody who's on this tonight will want to join us on July 19th. Attracting and retaining associates is the biggest challenge of building a group practice. And it's one that everybody struggles with. So there'll be a lot of meat and potatoes on that one, a lot of value-added content. And I hope everybody will join us. That'll be the Wednesday that I'm coming back from vacation. So I will be tanned, rested, and ready. And
Perfect.
There's nothing I would rather do than come back from vacation to talk about associates. So there you have it, Kelsey.
Perfect. I love it. Well,
Awesome.
Everyone, have a great night. If you need anything, feel free to reach out to us via the CE Zoom account or emails there for contact. And have a great night. We'll see you next time.
Cheers. Thanks, everybody.